Hey guys, how's it going? My name is Jason Sari. I'm a financial advisor with the Premier Client Group. I run this YouTube page and a Facebook group called Financial Education for Retirement on the side, just to help anybody who needs help with financial planning and financial education. But let's get into the video today on financial planning for beginners in 2025. Beforehand, just as a disclosure, everything in this video is solely educational. There is nothing that should be taken as advice without contacting a tax, legal, or investment representative first. So guys, before I start getting into it, what will be covered in this video today is financial planning for 2025, getting started investing and why you should invest, how to invest, what your options are, what accounts you can invest with, and what different types of funds you can buy, ETFs, mutual funds, stocks, bonds, that sort of thing. Then we'll segue into whether or not you need an emergency fund before you start to invest, just to make sure you do have some security. And then lastly, we'll get into a little bit deeper financial planning, more in the weeds financial planning before ending off the video. But again, guys, feel free to skip through anything you have no interest in, but let's get into it. Whether you just turned 18, maybe you have a little extra cash, maybe you just heard from your friends that they made 40% in the stock market over the past couple of years. Whatever the case is, you are ready to invest. You are ready to learn about investing and what a financial plan means for 2025. So like I said before, the stock market is up about 40% over the last couple of years. The S&P 500, or the 500 largest companies in the US, is an index that over the past 2 years has been up 40%, and it is a very common index for the US. And you might be thinking to yourself, why would I invest now while the market is so high? But it depends on what your goals are. It depends on how long would you like to be in the market. It depends on how quickly or not that you need the money and your overall financial plan. But let's try to get into a little deeper what makes sense for you and the path you should follow for 2025. Now, no matter how old or young you are, I'm sure you've heard the terms stocks and bonds. Now, a stock is an equity or represents a share in a company, while a bond represents debt in a company. Growth comes from stocks, while bonds produce income. Bonds are usually more safe, and stocks are usually more growth oriented. The proportion of whether of stocks and bonds that you buy depends on your financial goals, where you are in life, and how fast or how long it is until you need the money. A stock, which is sometimes referred to as an equity, is usually held for the long term. Now, I'm sure you've heard of day trading before, but it's more or less a scam, and people who say they make money in it probably don't make money in it. There's very experienced traders that are successful at it sometimes, but if you see a class on how to day trade, or some Facebook post on how to day trade, or some Discord on how to day trade, they're probably scamming you, or they're just probably trying to have you buy their course, whatever it may be. Just beware of people that say they are making millions of dollars day trading because they're probably lying. But back to the video as far as holding stocks go long term. Now, as you know, the stock market is not guaranteed. Some years it's up 20%, some years it's up 30%, some years it's down 40%. So you really can't guarantee on a steady growth from the stock market. In the long run, you more or less can. It's still not guaranteed, but you can plan on about a 9% annual return from the stock market from the S&P 500 per year. Now, by the same token, if you buy a stock, it is better to hold it for the long term than it is the short term. Because if you're down 20% in a year in the stock market and you sell the stock, you're really going to be hurting your growth on the way back up. Now, if you have short term goals or you don't want to risk the cash or you have a lower risk tolerance and want that steady growth, this is where bonds come in. Bonds pay out guaranteed interest. Now, some are not guaranteed for principal, meaning they can default if the company cannot pay them back. But if you buy a bond issued by the US government, it is guaranteed for both principal and interest. With this, if you buy a bond for the short term, they don't fluctuate as much as stocks. They may go up and down here and there as far as principal is reflected, but it is much safer than buying a stock, especially that it's guaranteed by the US government. Now, you can also split these up. That's where you might have heard the term 60-40% or 60% stocks, 40% bonds. There's also 50-50s, 90-10s, whatever makes most sense for your goals. If you are more risk tolerant, you might be more on the equity side, more on the stock side, if you're able to fluctuate the market and not get scared. But if you don't want fluctuation, you might be more on the bond side. That's where the 60-40 and the 50-50 comes into play. You might even be heavier in bonds, maybe 60% bonds or 70% bonds. Who knows? It's whatever your goals are, whenever you're going to need the money, and how much movement in your money you can actually tolerate. That is your risk tolerance. So why should you actually invest? This seems a little stressful, I bet, as far as what to pick, what stocks to pick, what bonds to pick, but it does really make a difference in the long run. I'll show you in this example exactly how much of a difference it actually makes. Now, if you've ever heard of a CD before, it's a certificate of deposit issued by a bank. Now, these produce about 2% interest annually. You can find some with more, find some with less, but essentially they're going to produce around 2% interest. So let's say you started investing in CDs at age 25. You got your 2% per year. You started with $50,000 for 40 years. In the 40 years, you would have $110,401. Now, this doesn't seem like a bad deal. It grew a pretty substantial amount. It pretty much doubled. But if you were to do the same exact thing, 40 years with $50,000 starting at 9% interest or 9% growth, instead of the 110,000, you would have $1.6 million. So investing in the stock market, investing correctly, and maintaining annual growth that is going to produce money for you in retirement is extremely, extremely important to achieving financial freedom in retirement. If you just roll it over to a CD, inflation is going to catch up to you, growth is going to catch up to you, and if the stock market does produce and the stock market does average that 9%, you're going to be way behind had you invested in the stock market instead of the CD. Now, you may be asking yourself, how in the world do I pick a stock that I know is going to grow 9% year over year in the long run? Now, the good thing is you don't have to. There are things called exchange traded funds, ETFs, and mutual funds. They aim to match an index and not just a particular stock. So instead of owning one stock, you own every stock in the index proportionally so. With mutual funds, they aim to either match or beat the index. They're a little more advanced, and you should probably stick to ETFs if you are just getting started. But an ETF aims to match an index over the long run. It can aim to match the S&P, the Nasdaq, the Dow, whatever it may be. But an ETF that is going to match the S&P 500 solely tries to keep in track with that line. It changes its holdings based on what is in the index and so on and so forth. So you're never really worried about missing out just because you bought one bad stock. You buy the ETF, you hold it, and you let it sit. What one for you? It again depends on your goals, but an ETF is a great thing to look into if you're just starting out investing. Now, there are two main types of accounts when you're really looking into investing: retirement accounts and non retirement accounts. A brokerage account is a non retirement account and probably the easiest account to open up. When you open up a brokerage account, you can buy and sell pretty much anything. But when you buy and sell, you are taxed. Well, when you sell, you are taxed. If you have a gain in a stock in a brokerage account and you sell, you pay tax. Long term capital gains or short term capital gains, that depends on how long you've held the stock. But I have a different video for that if you'd like to check that out. With a retirement account, however, like an IRA or a Roth IRA, you can trade tax free in those, but there are certain restrictions. You can't take the money out before 59 and a half, or you're hit with tax and penalty, and a couple other restrictions apply. So definitely check out a video on the difference between a Roth and a traditional IRA and whether or not a brokerage account or a Roth or a traditional IRA makes sense for you. But those are two different types of accounts that you can look into opening up just to be able to start investing at whatever age. Moving on, however, let's get into what an emergency fund is. So, an emergency fund is pretty much defined as a cash or cash equivalent set aside for an unforeseen circumstance. When you're in the stock market, even in the bond market, it might take a day to get your money and you might need it immediately. So, you have this fund set aside just as a safety net in case something were to go wrong and you needed cash immediately. Now, typically, the amount you should have in your emergency fund depends on your income sources. If you have one source of income, you should have 6 months of fixed and variable expenses in your emergency fund in the cash or cash substitute. But if you have two sources of income, you could have 3 months and still be considered safe. But again, if you have a big purchase coming up, it might be safe just to have 6 months of those fixed and variable expenses saved up, even if you do have two sources of income. Now, a couple other things to keep in mind as far as financial planning goes for 2025, more in the weeds financial planning, is tax planning, retirement planning, estate planning, investment planning, and insurance planning. As far as these factors of financial planning go, they all balance with each other. But as a basic of each one, retirement planning deals with your assets now, your income now, and how much you can spend in retirement. Estate planning is trust and wills and making sure that your assets go to your heirs the way that you want. Insurance planning is making sure your heirs are taken care of if you are a primary income earner. Investment planning makes sure that your assets grow with you and your lifestyle. And then the other couple aspects of financial planning, they all work together with these just to make sure you have a safe and sound financial plan. Otherwise, guys, I hope you enjoyed the video today. I know there was a lot. I have other videos going over the topics that I only briefly explained, but definitely check those out. Drop a comment and subscribe if you want me to make other videos for different topics you have, and check out the Facebook group Financial Education for Retirement. It's a group of certified financial planners as members that are just willing to help and answer any questions at any point in the day. But I hope you guys have a good rest of your day. See you guys later.